Welcome to the Lifestyle Property Podcast. I'm Jamie Greaves, your host and professional property investor. I'm here to bring you insights, home truths and powerful stories about what really goes on in property investment, business and growing your dream lifestyle. Are you ready? Let's get into it. Welcome back to Lifestyle Property. Hello there and welcome to episode 20, which is called Jargon Busting. And before we get into it, Happy New Year. I hope you've had a wonderful festive period. And let's start the year off with a bang. Okay, welcome to 2025. And what I'm going to do today is bust common jargon which causes overwhelm in our sector. And it's along the theme of what I've been covering recently. And what I'm looking to do is provide clarity and get rid of overwhelm for all of us. So if you haven't listened to these, I definitely recommend going back and listen to episodes 16 and 17 as well. So in episode 16, we covered myth busting. So we busted common myths which hold us back investing in property and growing our dream lifestyle. They definitely held me back. And then in 17, we covered school day. So what are some key economic, banking, property fundamentals that we all need to know? So really, really rich content. Then in podcast 8, in the 18th podcast, I interviewed Nana, a wonderful guy, all about how to invest in the UK from abroad, and loads of tips and lessons in there, really, really rich. But Nana did drop in a few phrases like lease option and rent to rent, and some of you will know them, but I'm aware that others of you won't. And certainly when I was starting out, a lot of the jargon thrown out there, it caused overwhelm and it confused me. And when we are overwhelmed and we're confused, we're not going to be successful in life. And this is what I want to get to. I want to give you clarity. I want to give you focus and help you start. And this is what this is the mission. This is what today's podcast is all about. Now, what I would say for this podcast is if you're anywhere between starting out to maybe a year, 18 months, maybe 2 years in max, then this is perfect for you. So this is the perfect podcast for people who are a bit newer, a little bit greener. Go kind on yourself there. This would be really, really valuable. If you're a seasoned property investor, you'll likely know some of these things. Okay, so you may not get as much from this episode as if you were a little bit newer. Okay, on this one. Having said that, towards the end of the podcast, as we get a bit more specialist in terms of some of the things that we're clarifying, you may well learn a thing or two. But certainly, if you're newer, and if you say anything up to say 4 or 5 properties, anywhere between 0 and 4 or 5, I think you'll find today really, really valuable. Okay, so I've got 12 bits of jargon, not jargon, but I suppose 12 terminologies, 12 terms that I want to clarify. Okay, so you know exactly what they are and how they apply, and I'm going to give you tips and tricks around them which will bring you value. Okay, so we're going to start out easy and then we'll get a bit more specialised as we go. Okay, so number 1 is BMV, which means below market value. So if you ever hear those words, BMV, below market value, what this simply means is you can buy properties below their market value. So for example, when an owner wants a quick sale, or an owner prefers someone reliable and trustworthy and will therefore happily accept a lower price for their property. And that is an amazing thing about property investment, because we can't do that with stocks or shares or Bitcoin or any other asset class. Okay, so BMV, below market value, and all you really need to know is you can buy property below the market value, and you can do it in a really ethical win-win way, which is very, very, very important. Okay. So term number 2, BRRR, okay, buy, refurb, rent, refinance, in that order. Okay, so this is momentum investing. This is when we're adding value. So think of it as it's a refurb project. We're adding value, normally through a refurb, sometimes through just a paperwork exercise. And it's similar to a flip. So I'm sure we all understand what a flip is, buy something, do it up, refurb it and sell it. Well, here, rather than selling, we're renting at the end. Okay? And so what's important to note is there's a bit more risk involved, but a lot higher reward. And it's a way of getting momentum, because if you've got a pot, you can recycle that pot. Because if you can add value and pull your money out, you can go again and go again. And this is how a lot of investors have grown their portfolios, ourselves included. And we can apply it to any strategy. Okay, so BRRR to holiday lets, BRRR to HMO, BRRR to buy to let. So you can apply it. It applies to any end strategy, and it's a form of adding value to the way buying properties. Okay. So that's what BRRR means. Momentum investing is how to take a pot and keep growing it by recycling the capital out. Number 3 is SA, okay, which stands for Serviced Accommodation. Okay, now I was on a webinar recently where a few people didn't know what this means. So let me just clarify for you. So whenever you hear SA, what this shortly means is just renting a property out on a shorter term basis, where everything's included for the guests. Okay, that's what SA is. Okay, so we'll be renting it with things like Wi-Fi and bills and cleaning, and it's fully furnished, so someone can just turn up from anywhere and plug in and not have the hassle of any of those things. Okay. Now, really what we're talking about when we're talking about SAs is it's often people working away from home. So it's contractors working away. Okay. And it could be from anywhere between, say, a week to 4 or 5 months. Okay. So this is what SA is. I'm just going to give you a brief overview today in terms of various terminologies, but I think it's good to get this kind of baseline knowledge on everything. Okay, really is. So within SA, the reason why people do it and the reason why I invest in it, and one of the core reasons is it offers a higher cash flow and a higher income than say traditional, say, buy-to-let investing. Okay, and a popular platform here will be putting your properties on something like Booking.com and then contractors staying there for weeks or months upon end, rather than taking on a long-term tenancy. But you'll provide everything for them, so it'll be fully kitted out. Okay. Terminology number 3 is FHL. So whenever you hear FHL, it's used more and more. Here we're talking about Furnished Holiday Lets, which again is one of my strategies that I focus on. So I can help you here, give just real clarity. Okay, so holiday lets are a form of SA. Okay, it is SA. But here we're focused on the leisure market. Okay, so a popular platform here might be Airbnb. Okay. Oh, just another terminology, just to bust for you, just to give you clarity. Whenever you hear OTA within SA, OTA, all that means is online travel agent. Airbnb, Booking.com, those types of companies. Okay. So within FHLs, within Furnished Holiday Lets, here it's when it's furnished and commercially let out for no more than 31 days. That's the official definition for it. But what we're focusing on here is a leisure market. So think staycations. Think Airbnb cottages. Think people going away for between 2 and 7 days. Okay, they're having a holiday. They're going away with their friends or their family. Whereas traditional SA investing, okay, terminology number 3 will be weeks upon end or months upon end, people working away from home. 4 is FHL, Furnished Holiday Lets, form of SA, just focus on the leisure market. Okay, staycations. Okay, I'm going to rattle through these because some of you will know them and some of you won't. So I want to give you as many as I can. Okay, give you clarity. Number 5 is HMO. So HMO is essentially a house share. HMO stands for House of Multiple Occupation. So it's a house share. So it's when 3 or more people live together. I'm sure you know them. You may have lived in them. You may have got family members who are currently living in them or have done. Okay, so HMO is this. Okay, so on larger ones, licenses can be required. A quick tip for you is just if you are doing HMO investing, don't mix tenant types. So a bit like within my world of SA, we either would be really focused on contractors or really focused on staycation holiday makers. Well, here within HMOs, you'll be really focused on either you might have a student HMO or a professional HMO, or even maybe a social housing HMO, but you wouldn't mix tenant types. Okay, and also just a little precursor here, don't over leverage as well, which I've covered before. How many is that? 5. Okay, so number 6 is R2R. Whenever you hear R2R, this is rent to rent. Now, as I'm reading through these, a lot of these seem really, really basic, but they're basic to me because I live it, I know it, I breathe it, but they may not be for you, so I really hope they're helpful to you. We are going to get into more complex strategies now. So number 6 is rent to rent. Okay, so this is when just really simply, this is when we rent from a landlord. We pay them. We pay a landlord a market rent. We look after their property. We keep it in really good condition, and then you're then renting that out as an alternative use. And the two main ways of applying rent to rent, there are some other sub-factors, but the two main ways are either as SA or HMO. So two of the strategies just discussed. So we either want to rent on a shorter term basis, i.e. SA, or on a room by room basis, i.e. HMO. And it's a way of making income from property without having to go through, without having deposits and buying. Okay, so we can do rent to rent with very low capital. Okay, we don't need deposits, which is amazing. What I would say there, and it's important, is we must do it professionally. We must focus on it. We must get the right knowledge on it, because we're taking the legal responsibility for someone's property, and we don't want to mess that up. We need to do it properly, professionally, ethically. Okay. Number 7, PLO, purchase lease option. This really intrigued me early on. Now, what is it? Well, it's really common within commercial property, and it's something that Nana mentioned on the interview a couple of weeks ago. Okay, because he's done a few, and I've done a few over the years. The thing to know, just to give you clarity, is there are two options. There are two aspects to a purchase lease option. There's the lease and then the purchase option. Okay, so in short, this is just where we're going to rent something until we buy it. Okay, so a good tip for you here, and a way of thinking about it, is think of it as a rent to rent with an option to buy. Okay, so something like a purchase lease option works better in SA or HMO rather than in buy to let, because we can do a normal rent to rent agreement on it. Okay, and then you're able to do that and pay the landlord market rent, and then we can get an option to buy included within there. So it's so actually having a high cash flow strategy allows us to do purchase lease options better, because it's a better win-win. You're able to rent from the landlord, pay them a good income, and then buy it later. So it's really common within commercial property. But just to demystify it for now, it's renting something until you buy it. Okay, that's all a lease option is. I'm going to rent it until I buy it from you. Can be done really, really ethically. Can be a nice win-win. Okay, number 8. I'm going to rattle through this for you. When you hear EDC, exchange with delayed completion, this is similar to a lease option, but you've got the obligation to buy. So here we're going to exchange contracts. So once we've exchanged contracts, we are obligated to buy, unlike in a lease option where you have the option but not the obligation. Okay, and you're then responsible for the property from the point of exchange. So we've agreed an exchange, so exchange contracts, but we're going to delay the completion. Okay, and we agree a later completion date that's mutually agreed between buyer and the seller. That can be a few months or a few years later, depending on the circumstance. Okay, so that's all an exchange with a delay completion is. And there are circumstances where it really benefits either the buyer or the vendor. So, and that's when we would then deploy one of these. Okay, so we exchange contracts. It's more committed than a lease option because you are obligated to buy, and we're just going to delay when that completion takes place. But you've exchanged contracts, so there's no option. You are fully responsible. Okay. Number 9. Now we're going to get into some more like meat and gravy stuff, some more specialist stuff. Okay. Off plan. Number 9. Off plan. What's off plan? Well, what off plan means is when we're buying a property before it's built. We're buying it based on the plans. Okay. Now, you think of that what you will. I'll give you my thoughts and my advice and my knowledge on it now. So the reason why this happens is that big developers, they like to sell this way because it gets them some money in the bank to keep funding the build. So if they can sell off some of their units, so maybe it's a new development or a big block of flats or housing estate, if they can sell a few off plan, they get some money in the bank that can then fuel further build. So it's a way of, it's quite a common practice. But my advice here, and now, is be very careful, okay? Because it's marketed very well. They'll offer quote unquote discounts to investors. So they put together very attractive proposals and marketing packs. But be very, very careful of off plan, okay? Now there's key reasons why. Well, and one of them is, this discount is not really a discount in my experience because new build properties are overpriced. There's a premium built in. So now technically we're in negative equity from day one because the new builds is just sold for a higher amount than what other residential property is in that area. So actually any discount you think you're getting is not really a discount whatsoever. And remember, guys, just a discount versus an asking price is not a true discount. We want a discount against the actual true market value. So yeah, new builds are overpriced, and you're buying an overpriced asset that's not even built yet. So it's doubly risky. And then because there are risks involved. Okay, so developers can go bust. Just think about the model. If they're having to fund their build by getting some money in, by selling off some units before they're built, should that give you confidence? It does not give me any kind of confidence. And anything can happen. They can finish it up to substandards. They can just not finish it. So you may have been abroad. You may have been in so many European countries and even further afield where you just see half-empty hotels or half-empty buildings. That's what's happened here. They've started the build. No doubt they'll have off-plan investors in that, and then they've gone bust, or they've over-leveraged, or you name it. There are many, many, many pitfalls to avoid. I do not recommend it. Okay, certainly not for anyone new or starting out or growing, or even, and then once you are a seasoned investor, you're not going to be buying off plan. Okay, because they can be overpriced, full of risk, many, many, many pitfalls to avoid. So exercise caution when you hear off plan, and these will be the most attractive looking marketing brochures out there because they've got the highest budget. So be very, very careful. Okay, so off plan means you're buying it based on the plans rather than you can't touch it or feel it because it doesn't yet exist. Okay, no thank you for me. No thank you. So exercise caution there. Be very, very careful. Okay. Number 10 are investment mortgages. And I suppose the key terminology here is you may wonder why investment mortgages are interest only. Okay, because our homes, when we buy our homes, they're repayment mortgages. So over time, we are paying interest, but we're also paying the capital down over 20, 25, 30 years. But in investment, most of your investment properties will be interest only, where we only pay the mortgage. So we only pay the interest. Okay, now why is that? And this is, and I'll come on to number 11, which is like loan to value now. So most investment mortgages will be interest only mortgages rather than repayment. Okay, now the reason being, and this kind of leads into point 11, it is LTV. LTV means loan to value. Okay, so that's our loan to value is what's our mortgage loan equal to the worth of the house. Okay, so for example, and I'll go back to the previous point shortly, but if our house is worth 400,000 and we have a mortgage of 300,000, well, 300,000 is 75% of 400,000, so your loan to value is 75%. Now, why investors and why investment products have become interest only is we investors, we want the cash flow. So we want the income. So we don't really want to be repaying down our mortgages. We want to be maximising the cash flow and the income for our lifestyle, from our investment properties. The beautiful thing that happens is over time, inflation erodes away the value of that debt. Okay, so Father Time looks after you and it erodes the value of that mortgage. Okay, so let me run through some numbers, and if you are running or you're driving, you may want to come back to this point and write some numbers down, because it's really important to understand terms like loan to value. Okay, so let's say, for example, you've got a house worth £300,000. Okay, it's not an off plan, so we know what it's worth. It's an existing property, 300,000, and you've got a mortgage on there of 225,000. Your loan to value is 75%. Okay, because your mortgage loan is equal to 75% of the current value of that house. Now, but what happens over time is houses grow in value. It said in the UK that they double every 10 years. Okay, but that's not an exact, and there's lots of market forces. But one of the benefits of the UK property market, and why Nana, who I interviewed recently on the podcast, he lives abroad, but he specifically chose to do best in the UK, is because of the capital growth we do get in the UK because of our high supply, so high demand, low supply, limited supply environment. So we get really good capital growth. So let's say this to go back to this house. Sorry, if I go on that tangent. So it's worth 300,000 when you buy it, with a 75% loan to value mortgage of 225,000. Let's say you fast forward then, say 10 years. Let's say it's worth 500,000. So we're not saying it's going to double. We're going to be even more conservative than that. let's say it just goes from 300 to 500, and I'll tell you what, guys, we get a lot more growth in that. We really do, but let's just be really conservative. Well, in that time, your mortgage doesn't go up. So your mortgage is still 225,000. So over time, your loan to value has dropped from 75% to 45%, and you've done nothing for it. It's very, very smart. So we want interest-only mortgages on our investments so we can enjoy the cash flow, enjoy the income, travel the world, treat your family, live your best life. We want that. And then we just want farther time. We don't want to over leverage and want to let our loan to values drop and drop and drop and drop. And we don't need to do anything for that. Father time will look after that. Okay? And finally, lastly, I could have done 100 of these, but I want all my podcasts to be 20 minutes. Otherwise, we switch off. So number 12 is JV, joint venture. So whenever you hear, oh, I'm looking for a joint venture partner, or I am a JV partner, or this or that, what this means, really simply, is it's a business partnership, okay, between two or more parties that involves, and this is the actual definition, shared ownership, risk, returns, and governance, okay? I.e., it's a profit share partnership, okay? We're going into business together. And this way, we can pool our resources. Maybe one person's got the knowledge in the deal, one person's got the capital, 1 + 1 = 3. It is a brilliant thing about property investment because we can pool our resources and acquire assets that we otherwise couldn't acquire and do things we otherwise couldn't do without joint ventures. They can be brilliant, but there is shared reward and shared risk. So we need to know what we're doing. Make sure that you're doing everything really, really professionally and ethically with the right agreements, the right legal contracts, the right knowledge. But if you do all that, it can be really, really powerful, and it's something that I've used in my portfolio time and again, and I really do love it because not only of the financial power of it, but the human connection of growing long-term ethical partnerships is really, really lovely. So there you have it. Starting 2025 with a bang. Okay, so 12 terms that if you hear them again now, you won't have overwhelm. You'll know what they are. You'll have clarity, which is brilliant. So I hope that's been really, really useful for you guys. Any questions about this or in general about anything whatsoever, you're welcome to reach out to me. And my Facebook is on the notes section. I started an Instagram account recently, but I'm quite poor posting on there, but I will get better. And my website's on there as well. So if you want to chat to me or connect, drop me a line. Happy New Year. Welcome to a new year. Make this your year. Very exciting year ahead. I'll see you next week. Take care. Bye-bye. Thank you for listening to the Lifestyle Property Podcast. If you've enjoyed this episode, I'd love it if you could leave us a review so we can reach and help more people. I'll also be giving one person who leaves a review a free family holiday to one of our luxury holiday lets. Thank you, and see you next time.